Reverse mortgages are a great hedge against property value risk, says a guy who's writing in Forbes. Let's take a gander, shall we? Let's gander on down. Now, this is from Forbes magazine. I always have a problem with Forbes nowadays. Anytime there's an article like this, because I think you can actually pay, I think it's like $2,000 to have an article in Forbes, actually. And it's that bothers me, man, because a sales guy with deep pockets can be in Forbes, and then he can say, as featured in Forbes, as if Forbes reached out to him when in fact he reached out to Forbes to pay money. I'm not exactly sure how the price mechanism is, but I was reading a guy who talked about how to get your stuff published in various magazines, and Forbes came to mind. I forgot, well, maybe it was a YouTube channel. I think it was. And I was like, man, that's, once you start allowing this kind of that kind of stuff. Now, I guess they got some editors at Forbes that make sure that it's legit, but I don't like that at all. But anyway, let's read. But let's read what this guy's got to say. I don't even know who wrote this. So, who's the author? Jack Gudentag? I'm not sure who that is. All right, so let's take a look. Part of the motivation to be a homeowner is the opportunity to accumulate growing equity in a home. Equity growth, however, is heavily influenced by market changes over which the owner has little control. 100% agree. House prices appreciate much more in some areas than in others, and there are some areas where there's no appreciation at all. Yep. A homeowner reaching 62 can begin converting home equity into spendable funds by taking out a reverse mortgage. HECM is a home equity conversion mortgage. A reverse mortgage. They just use HECM because most people are familiar with HELOC. But remember, two completely different things here. In calculating the amounts that a senior can draw using a HECM, the government assumes the borrower's house will appreciate by 4% a year. What? Is that true? This was the average rate for all areas over a period of many decades. The individual taking out the reverse mortgage could experience a 4% appreciation, but the more likely rate will be higher or lower. The way the program is designed is that the borrower is protected against the adverse consequences of a rate below 4%, but allowed to enjoy the benefit of a rate above 4%. The HECM program allows the owner to hedge his property value risk, and here's an example. Jane Doe has a house worth $200,000 and wants to draw the maximum amount possible every month for as long as she lives in the house. That's called a tenure payment. Not a 10-year payment, but a tenure, like these professors. They're tenured. As of February 15, 2021, the largest amount available from any of the 6 lenders who deliver their prices to my website will be $415 a month. So if she has $200,000, she's 64, $415 a month. You times that by 12, that's $5,000 a year essentially. So that's a 2.5% distribution yield essentially. So $5,000 a year. That's $49.80 on $200,000. So she gets she's looking at a 2.5% distribution yield, tax-free, return of principal, which is nice, and it'll never stop ever. It'll never go down. It'll never go down. Well, we'll see. Let's keep reading. Now, consider the implications of 2 extreme assumptions about the future value of her property. In assumption 1, the appreciation is 0, meaning the property value remains at $200,000. Oh, there you go. Her home equity conversion mortgage debt, however, rises every month. And assuming the initial rate on her reverse mortgage is 2.57%, her equity will be reduced to $47,000 after 20 years. You got that? So she starts with $200,000 with no debt on it. She takes a reverse mortgage. She gets $5,000 a year for 20 years. So she takes out $100,000. But because the interest at 2.57, she owes $153,000 on a $200,000 mortgage. All right, on a $200,000 fair market value of her home. So she's left with $47,000 after 20 years. However, there's little chance that initial rate will hold for 20 years. The more plausible assumption is that the rate will quickly rise to the maximum of her mortgage, which is 7.5. At that rate, the loan balance after 20 years would exceed the property value by $83,000. So the loan value goes up. She could be underwater. It doesn't matter. It's a non-recourse debt. She'll never owe more than what the fair market value is, and neither will her heirs either, by the way. Nevertheless, neither Jane or her estate will be liable for the deficiency. There are no deficiency judgments in the reverse mortgage program. Losses such as the one described above are taken as a charge against the government's reserve account, which we all pay insurance for. Was the lending, not the lending fee. Anyways, the insurance. That's 2%. So she would pay $4,000 on closing because her house is worth $2,000. There's a 2% insurance fee. I'm just drawing a blank what it's called, some kind of insurance fee on the fair market value. So she pays $4,000 into the insurance. So while the government is taking the hit, well, essentially it's all the reverse mortgage borrowers who pay into it. In some, let's see. In some, Jane continues to receive the payment calculated on a 4% appreciation assumption, even though her house is not appreciated at all. Now consider the implications of an alternative assumption where Jane's house appreciates at 8% a year. That means after 20 years, her house will be worth $932,000. So we start with $200,000 and went to $932,000. Assuming the interest rate jumps to her max at 7.5%, her loan balance would be $283,000, with $649,000 of equity. She could leave the equity for her estate, or she can convert it into a larger monthly payment by refinancing. That means paying off the balance between the first home equity conversion mortgage and drawing a 10-year payment on the new one. Her monthly payment would be about $2,800 a month in this scenario, many times larger than the first, reflecting both the equity growth and Jane's age. Because as you get older, you can borrow more. Now, remember, she'll have to pay a 2% insurance premium on the $932,000 if she were to refinance. So her insurance payment would go from, what is it, $4,000 to $20,000, right? Yeah, to $20,000. So a pretty significant fee on just the insurance premium going to the government who back writes these out. In sum, the HECM program allows eligible owners to benefit from unusually large house appreciation without bearing the risk associated with low or no appreciation. Unusually low interest rates increase the benefits. And you have a table here which, let's see, so we got 4% house appreciation. After 20 years, her house would be worth $438,000. Her loan balance under the current rate would be $153,000. Her loan balance under the max at $757,000 would be $283,000, so she'd have $153,000 of equity in that case. So that's good. So, I mean, again, that's a higher interest rate. Lower interest rate, she has more equity. She has only $153,000 loan balance, a $438,000 home value. That's after 20 years, and she'd have $285,000 of equity. So that's pretty good. And you can see after 30 years, if she had no appreciation, and she had no appreciation and the highest interest rate throughout the 30 years, her estate, well, she'd have no equity in her home. She'd be underwater, but again, the government eats that because she paid the $4,000 premium to get this, or the insurance payment to get this thing started. So that stinks for her, but it doesn't matter. I mean, she still has her house. She'll never be put out of the house at all, and she has negative equity. All right, good stuff. So this guy, Jack Gutentag, at various times he was chief of the domestic research of the Federal Reserve Bank on New York. Okay, cool. Senior staff on the NBER, National Bureau of Economic Research. Right on. He's got a website, mtgprofessor.com. Let's gander over at mtgprofessor.com. All right, cool, man. Shop with a mortgage with a professor on your side. There you go. I like it. So we'll have to... right on. And there he is. Is that the good professor? Yeah, right there, man. Jack Gutentag, professor of finance at the Wharton School of the University of Pennsylvania. All right. Professor of finance emeritus. Author of the Mortgage Encyclopedia. All right, well, there you go, man. So, just get calculators. Sweet. List of calculators. All right, cool. Retirement, mortgage refinance, mortgage payoff, mortgage payments, mortgage amortization, mortgage. How about home equity, conversion mortgage, second mortgage term calculator. Yeah, why is it so hard to get a HECM calculator? I tell you, I don't get why it's so hard to get one of these things. Weird. Anyway, so good stuff there, man. Mortgage interest, mortgage consolidation. Look, if you're not looking at a mortgage or reverse mortgage as one of the tools in your toolbox, I think you're making a mistake. That doesn't mean you got to do it. I just don't understand why you would not look at one. Don't listen to Dave Ramsey saying they're scams. No, they're not scams. It's just the whole thing stuff. All right. Like to hear your thoughts. We'll see ya.